We are in the middle of the biggest shakeup to international tax in, well, about 100 years. And at the very heart of it all is a brand new, powerful idea called Pillar 2. It's a truly comprehensive global system, and it's designed to do one thing: make absolutely sure the world's largest companies pay a minimum level of tax, no matter where they do business. So let's break down how it all works.
Here's what we're going to cover. First, we'll look at the big problem that forced more than 140 countries to get in a room and act. Then, we'll check out the two-pillar solution they came up with. We're going to dive deep into the comprehensive rules of Pillar 2, figure out exactly which companies are on the hook, and finally, see what this new reality actually means for them.
So, before we can really appreciate the solution, we have to understand the problem. And for decades, the global tax system has been stuck in what experts call a race to the bottom.
In that race, it leads to this one fundamental question. How on earth can a massive company earning billions of dollars in revenue end up paying what looks like a shockingly low amount of tax? The answer, as you'll see, is hidden in the gaps of the old international tax system.
This is the core idea of something called base erosion and profit shifting, or BEPS for short. Essentially, companies could legally move the profits they made in a high-tax country, where they actually had customers, over to a low-tax country where they might have nothing more than a post office box. This just systematically drained tax revenue from countries all over the world. This chart right here, this shows you the playground for that kind of tax planning. Just look at the wild variations in effective tax rates across different regions. It's this patchwork of high-tax and low-tax places that created the massive incentive for companies to get creative and shift their profits all over the map.
Okay, so faced with this enormous challenge, over 140 countries got together under the OECD and G20 to build a unified response. And the result? A really ambitious two-pillar solution.
You can kind of think of this whole thing as BEPS version 2.0. This isn't just about patching a few holes in the old system. No, this is a fundamental, comprehensive rethinking of global tax rules for the modern age, all built on this idea of cooperation to stop aggressive tax planning for good. Now, the solution is split into two parts. Pillar 1 is all about where companies pay tax, shifting some of those rights to the countries where their customers actually are. But our focus today is all on Pillar 2. This is the one that's about making sure that no matter where a company books its profits, those profits get taxed at least a minimum rate. It's designed to finally put a floor on that race to the bottom.
All right, let's get into the nitty-gritty of Pillar 2. Now, this isn't just one simple rule. It's a really comprehensive and interlocking system of rules, all designed to make sure that tax floor is solid.
And this is the magic number, the single most important number in this whole new framework. The globally agreed minimum effective tax rate is 15%. If a company's tax rate in any given country drops below this, the new comprehensive rules kick in to top it up.
So, the engine that powers this entire system is called the GLOBE Rules. It's short for Global Anti-Base Erosion. This is the technical framework, the machinery, that countries are putting in place to enforce that 15% minimum, one jurisdiction at a time. So how does the system actually collect the tax? Well, the first line of defense is something called the QDMTT. This basically gives a country where a company is making low-taxed profits the first shot at applying a top-up tax itself. This ensures that revenue stays right there in the local economy. But what if that country doesn't implement a domestic top-up tax? What happens then? Well, that's where the second layer, the Income Inclusion Rule, or IIR, comes into play. This allows the country where the multinational's parent company is based to step in and collect that top-up tax instead. And finally, there's a backstop for the backstop. The Undertaxed Profits Rule, or UTPR, is the ultimate safety net. If, for any reason, there's still some undertaxed profit left over after the first two rules have been applied, the UTPR allows other countries where the company has operations to collect whatever's left. It's incredibly comprehensive.
So if you put it all together, you can see this creates a really clever cascade, kind of like a waterfall. First, the local country gets its chance with the QDMTT. If that doesn't happen, then the parent company's country steps in with the IIR. And as a final failsafe, other countries where the group operates can collect any remaining tax with the UTPR. The system is designed to leave absolutely no gaps.
Okay, so with such a comprehensive system in place, you're probably asking, who exactly is affected by this? Which companies need to get ready for this new world? The line in the sand, the one that was agreed on globally, is 750 million euros in annual revenue.
This isn't aimed at your local small business. This is a system designed specifically for the largest multinational corporations on the planet.
And there's a very specific test to figure out when a company is on the hook. The rules kick in once a company's revenue goes over that €750 million mark in at least 2 of the 4 previous years. It creates a really clear and consistent trigger.
But even for the big groups that cross that revenue line, certain types of entities are specifically carved out. These are generally what you'd expect: government bodies, international organizations, nonprofits, and some pension and investment funds. Basically, the types of entities these rules weren't designed to target in the first place.
As you can imagine, complying with a framework this comprehensive is a lot more than just a new calculation. It involves a huge amount of new data gathering and reporting for these multinational groups. Yeah, the new administrative burden here is pretty substantial. Companies in scope now have to file a super detailed Globe Information Return, or GR. On top of that, they'll need to submit annual notifications and maybe even file totally separate tax returns just to handle their liabilities under this new system.
And all of this brings us to our final thought. We're stepping into a completely new era of global tax cooperation, one that's built on a truly comprehensive set of rules designed to level the playing field. So the big question now is, how will this fundamental shift reshape the world we live in? From the way companies plan their business all the way to how entire nations compete on the world stage.